This is Trend Following Radio, where great thinking comes alive. Nobel Prize winners, legendary traders, best-selling authors, and the pros that know what drive us irrational human beings. I am your host, Michael Covel. Not filtered, raw, honest. That's my passion. My guest today is Mark Sleeman of MS Capital Management. Mark has been trading since the late 1980s. He's a self-taught trend-following trader, but he has also been wise enough to reach out to mentors along the way, David Drews, Ed Seykota. A classic trend-following conversation I hope you enjoy. My first question I have to ask, before being introduced, have we crossed paths somewhere, online, somewhere? I just feel like we have, or is it this is our first time crossing paths?
This is our first time. I've certainly heard of you and got some of your books, but I don't think we've ever talked or corresponded apart from the last couple of days.
Okay, I was just curious. And I tell you, I'm in Asia. I'm not used to having somebody in front of me. No, you're 5 hours in front of me. You've got to be close to the date line, if not on it.
We're in front of just about everyone, I think. But yeah, people sometimes find that hard to grasp, especially when they're in the US and they're behind everyone.
Oh, so listen, today I'm going to cover a lot of territory. You've got a lot of different insights you can give my audience. I'm sure about that. But I think one of the first things that would be great to jump into, so here you are, you're a systematic guy, a quant guy, you're trading trend following type systems. When was the first moment? I know your trading goes back to the early 90s. I know you started trading for clients in 97. But what was that first moment where you saw just the idea of a systematic trend following system could work? I mean, you're probably like most of us, we see the fundamental trading, the Warren Buffett. What was the trigger, that first moment where you said, there's something else out there?
Yeah, I don't think I ever started from a fundamental viewpoint. I just started from a viewpoint of making money. And I think when I first started I opened my first futures trading account way back in 1988, and I lost money straight away, which was actually a really good thing. I didn't think so at the time. And I was really searching for some way of making money. And I was actually in Sydney, Australia on holiday, and I popped into a bookstore downtown and always liked to look at the financial books, and I saw a book by a guy called Stanley Kroll. I don't even know if I can remember the name of the book now. I've got it in my bookcase here somewhere. And he was trading systems way back in the 70s. That's where I got the idea, really.
So it was literally just that first book. I mean, you have an engineering background, so you have no problem with the idea of a, quote, system. So it was that first book, and that was the trigger. Now, were you on your own at that moment where it was like, okay, I'm just going to go back into my lair, so to speak, and research and execute and create? Or was there other people you were talking to, a mentor? What was happening at that time?
Actually, I've just got the book off my bookcase, so I'm talking to you. It's called Kroll on Futures Trading Strategy by Stanley Kroll. Tremendously clear thinker, this guy, and not many people have heard of him. I don't think. Maybe.
I've heard the name, but I've not read the book.
I think he's deceased. I think he died maybe 10 years ago. I started on my own with that. I wasn't actually a systematic trader still, but I was using those principles on a discretionary basis. And really, the difference between discretionary trading and systematic trading at that level is not that great. In fact, it's a system that's just automating the same process.
But were there any early on or even later on, were there any mentors, anybody that came into your life that helped you to take your process a step further?
New Zealand's a small country, and the futures business in New Zealand is smaller than small. And I was trading at the local commission house, and they put me onto a guy who had just basically gone professional. His name is Robert Holroyd, and he, amazingly enough, it was really being mentored by David Drews and Ed Seykota. So it's a tiny, tiny world. very sadly, Robert's actually dead now. He was a great guy, and he was really the pioneer in this country, and he certainly helped me.
Let me pick on one phrasing that you've used a couple times in our conversation so far today. You've said futures trading, and I sometimes like to pick the bone to say, I mean, are you really a futures trader, or are you a trend following trader who happens to trade futures?
I think to this point, I've been trend following futures trader. I'm certainly looking harder at equities, if that's what you mean by the question.
Well, I guess sometimes, someone asked me the other day, they said, hey, Mike, where do I, is a new person, and they said, where do I start trading stocks? And I wanted them to think about the idea of, don't focus on the market, don't focus on the instrument per se, but think about what your strategy is going to be. And so I guess when you say futures trading, to some degree, I think it downplays what you really do. Does that make sense?
Yes. So yes, I run a system on markets, and they happen to be futures markets. Is that?
Yeah. I mean, I don't know if you think I'm picking a fine point here, but I think sometimes people they hear commodities, for example, and you trade a lot of commodities, but it's not that I think sometimes people will hear commodities and they will have these preconceived ideas that this is complicated, or I can't begin to know all of that. But to just say one trades commodities and not mention the type of system they use, well, hold on, you don't have a commodities expertise, do you?
No, I have a systems expertise. You are correct. I think the big thing with futures is the leverage. We would say leverage. You'd say leverage. That's a big advantage. Certainly what drew me to it.
Well, talk about that. Talk about why look, because we saw in the financial crisis, there was a lot of leverage that went the wrong way, but leverage is just a tool. Go into some thinking here on your leverage, on why the leverage motivated you. Because, clearly you can go the other way on leverage too. You could lose it all.
Sure. It's a two-edged sword, as everyone, it's well known, it's a two-edged sword. But leverage gives you the advantage to move more size, whether that's in a mechanical sense, you're using a winch to pull your boat in. You could never pull your boat up onto a trailer just by yourself. It would be impossible. So you use a winch, which gives you leverage. Futures are the same, so there's the opportunity for a very large profit. Sadly, there's often not enough of those very large profits. But I think that was the opportunity of those is what drew me into it.
I think one of the things that'd be fun to break down, I saw some research from you. Everybody wants to buy low, sell high, right? This is what everyone wants. This is the panacea, the holy grail, so to speak.
I do too. I never seem to manage it.
Yeah, but you've actually taken this to a fairly kind of really broken it down and done some system testing. And it looks like, just as a side note, it looks like you're a fan of Bob Spear at Mechanica, huh?
Yeah, he's a gem, I think. It's a great program. He's a good guy. And there's not many people out there who write that kind of software who understand much about trading, but Bob is the exception, I think.
Yeah, I had a chance to go over and meet him. We've communicated a lot over the years, but when I was in the East Coast, I went over to Annapolis one day and we had lunch. So I can't say that I've had a chance to go out and see Bob face to face. So
I've been down to his place in Annapolis and we went out for dinner one night, and certainly, worthwhile.
Yeah. Let me take that back, though, as a side note about Bob and his testing software. And as you correctly say, it's one of the best, if not. You have something that you've put together for those that want to think they can buy low and sell high, and you've called it the grab system. Why don't you take as much time as you need to start to walk people through this idea? Because, look, it just seems so simple. Let me find something that's cheap, and then I'll sell it when it gets high. And let me just repeat that process and make it a system. But things don't really work out that way so great, do they?
Not in my experience. I did that work with Ed Dakota, and it was his idea to have a look at something like that, a system that buys low and sells high, i.e. tries to pick market bottoms and tops. And you can find a system that does that for a market or even several markets over a certain period of time, but when you apply that system with the same parameters over 20 markets, say, for 20 years, it just doesn't work. The only way you're going to get that to work is to change the parameters all the time to match the market. Someone out there may be able to do it, but I don't think I can, because you're just pretending that you know what's going to happen, and in my experience, you really don't.
Yeah, because I mean, the idea of buying something cheap, there's so many instances we can all look through the price data that you might want to buy something cheap, but it could just keep going down the other way. In fact, I see this right now with discussions about something as simple as the Shanghai Composite. I mean, the typical people will come on the shows and they'll say, well, it's down 30%. It's a buying opportunity.
Yeah, right. And look, I think a long-term bull market, as we've had in equities, will engender that kind of mentality. After a bear market, no one thinks about that. So part of it is your historical perspective. If you think the market is going up and this is just a blip, you're going to want to buy cheap. But I always looked at this thing as something I was going to do for the rest of my days, and I wanted something that didn't work, not that worked perfectly, but worked consistently, and trying to pick bottoms and tops just doesn't seem to work consistently.
So let me go back in time a little bit before I bring things up to current day. Degree in engineering, as I mentioned, you were in construction, so you're trading from the late 80s to the mid to late 90s for yourself. You decide that you're going to now trade for clients. You're gonna take your insights to the public, so to speak. But you undertook a fairly big event, a fairly big bet on yourself, and you sold something that most people would not think about selling to start a business. Why don't you explain that story?
You know, the big problem with trading futures, or any business really, is you need capital. And there's no easy way around that in my experience. You know, you can get someone to, in quotes, give you capital, but generally they want a big share of the business. If you can convince them to do that, you can maybe get some off your family if they're wealthy, maybe. But I mean, I came to the point where I didn't have enough capital to trade effectively. You need a certain amount to make it all work. And I sold my house. So I was single at the time, so that made it easier. If I was married, I don't think my wife would have let me. It was a huge decision but I was very confident in what I was doing. Not that I was going to necessarily win, but I knew I wasn't going to lose much because I'd done a lot of work on risk control.
Let's talk about that too. One of the things that you've talked about early on is you were very motivated by, as being in a position, as you just described, not to want to lose money, not having a lot of money. So you are thinking, I need to protect my downside. This way that you've gone about doing it is really built around one key word. And I would love for you to kind of explain that, tear it apart a little bit, but you're a very robust individual in terms of your trading, aren't you?
It's certainly my goal, for sure. Yeah, definitely robust. And again, that comes right back to, I decided this was something I was going to do for the rest of my days. And if you're going to do it for the rest of your days, you've got to be robust, because you're going to see good markets and you're going to see bad markets. And I've certainly seen both, and expect to see more of both.
Talk about the robust system and the robust approach in the sense, and maybe even define it a little bit for people that are sitting out there. I mean, look, I've got many people in my audience that know exactly what you're talking about, but some new people that probably don't necessarily understand what you mean when you say robust in the context of a trend following system. And to take that one step further, it's really about, you don't want to break. You do not want it to break. So you want to be robust so there's not a breakage.
That was the word I was coming to. You don't want it to break. The key word there is break. Sometimes it will perform poorly, but you don't want it to break down and lose all your money. And risk control is part of that, but also your trading strategy is a big part of that. And that comes right back to what we were just talking about, where you're trying to buy low and sell high. That is not, in my opinion, and as a product of my research, that is not robust. You really need to get aboard a move once it's started rather than trying to pick it, in my opinion.
Look, you're the teacher right now, and you have got a class in front of you, and you're going to start to get, or maybe even you got to give the quick elevator pitch. Break down robust for the audience. What do you mean when you say it in the context of your world?
Robust is something that loses small and wins big. There you go. That's a very basic approach. You're trying to take the big wins. The price for that you pay is losses, but they need to be small. And if you have small losses, you can have a lot of them while you're waiting for the big win.
Why do you have to have any small losses? I'm just being facetious here, but why do you have to have any small losses?
Never know where the market's going. You might have a feeling, you might have an indication, you might even be riding the trend, but it can always turn against you, and often does. And trend following systems invariably have a win-loss ratio less than 50%, often well less than 50%. And I was trying to explain what I do to some friends over the weekend, and I said my system wins 38% of the time. And I could see them look at me. You can always see the look in their eyes, and they go, "This guy's a complete idiot." But I said to them, the important thing is not your win-loss ratio. The important thing is your average win over your average loss. If your average win is much larger than your average loss, you can lose more than half the time and still make money.
That's the magic, or that's one of the magic elements of this. And I'm looking at your stats right now. Your percent wins is 39.9%. Your average wins divided by your average loss is 2.64. You basically have big winners and many small losses. And you have those small losses because when you take a bet, when you get a signal in your system or a moment for entry or exit or whatever, you don't know what's going to happen.
Well, generally, often it's wrong. That's probably the safest bet. It's wrong. But you live with that because you know occasionally it's going to be not just right, but very right, if that's using English correctly.
But see, here you are with that type of thinking in so much of the world. I mean, we call this, I think most people would call what you just described, what I'm talking about, as alternative thinking. But so much of the world still today, very bright people, some of them not so bright, really want to think that winning percentage is going to be 100%. I mean, it's almost a delusional type thing where I love when I talk to someone like yourself, you're saying, look, let's just be honest about this. We can't have 100% win rate. So, but it seems like so many people don't want to accept that.
Look, I hope people don't accept it. I mean, I'm being facetious myself, but I mean, I have to make money from someone. I guess that sounds rude. I don't think. I mean, it's counterintuitive. Look, it was counterintuitive for me too. I mean, it's not something that you just come to. It took me a lot of time, and I think it takes most people who do this. I think it probably takes them a lot of time.
Hold on, you said you were rude that you have to make money from someone. I mean, this is the zero-sum game. This is not rude. This is why the futures markets were put together.
Well, the futures markets were put together for the commercials. But yeah, I mean, we're going in there and taking a speculative risk. That's the other thing I say to people. The futures markets weren't invented for me. They were invented as a business tool for the commercial producers in each commodity or index or interest rate. We just go in and try and find opportunity and provide liquidity. That's our service.
I thought David Drews had a great backstory to how he came about it, and he did not come about it. He started to say, what are all these hedgers doing? And this he was looking at it in an entirely different way. He was more at the level of the futures markets functioning and developing his trend following system from there. And then when it was all said and done, he ended up having a similar approach. Very interesting story there too.
Yeah, and I think anything Dave Drews says or writes is well worth listening or reading or listening to. I haven't met Dave Drews, although I think I said before that my early mentor Rob Holroyd, he was kind of one of his, Dave Drews was his mentor. So I think I got his philosophy by osmosis.
Hey, let me take a side note for a second. You mentioned Ed Sakota and doing this project with him. You know, Ed, I've had a chance to meet Ed several times, and I just think of him as one of the most interesting and perceptive, bright individuals that I've ever had the good fortune to be around. But I think for people that are on the internet and maybe they see a video or they go to his frequently asked questions, they might not necessarily understand the depth. I don't know if there's anything you might want to share or that you can share about your perspective or your feeling about the benefits that you've seen in having interactions with Ed Sakota.
I think there's three things about Ed Sakota which certainly make him unique and an incredibly useful resource, if that's the right word. One is, and I haven't met him, I've done research with him, spoken with him on the phone and stuff, and so, I mean, we've done some research together. Of the three things, the first thing is he's a tremendously bright guy. I don't think anyone would really question that, and he's got a very inquiring mind. So you've got this very smart guy. That's the first point. The second point is he's tremendously experienced. He started trading futures when? The late 60s, early 70s, so 45 years ago. And he's obviously still doing fine. And you just can't buy that experience, you know. He's seen the boom markets of the 70s, he's seen the bear markets of the 80s, he's seen the tech crash of 2000, he's seen the global financial crisis, he's seen so much, and he's still there. And three, he's sharing this information with you for free. I mean, even if there's other guys out there who are that bright and that experienced, they're not writing a blog on the internet about it. I mean, Ed he gets something out of doing that. Maybe because he's giving back, or maybe because it helps his own process. I'm not sure, but he's sharing it, and it's there for you if you want to go and read it. I mean, you want to do some research with him, you can email in, and you might get to do a project. Amazing, I think.
I think what's interesting too about the way that he presents information, I'm sure a large segment of the audience, like Ed just doesn't spoon feed you. He tells you how it is, and I'm not saying it's a purposeful riddle or a mystery, but I think there's a lot of people that probably read some of the things that Ed says, particularly on his frequently asked questions, and they miss the punchline, or they don't get the real point. It just kind of glosses over. I'm sure that happens, and I'm sure it's intentional on his part.
Yes, the stuff there is slightly cryptic, or you could say it's just the really important stuff, but most people don't realize it. And the psychology of trading is tremendously important, and you really only know that once you live it. So I can look at the stuff Ed Sekoda says and I go, yeah, I get what he's talking about because I've been through it. If you're just starting out, it's harder to grasp, definitely, I think.
One of the things when I'm looking at your track record right now, I'm looking at the ups and downs of a robust trend following track record from the late 90s until today, a long stretch. When I see these large up and down moves, I think sometimes people don't quite understand that a good trend following approach is about skill plus opportunity. You can have all the skill in the world, but the markets have to cooperate, don't they?
Sure, you can only take what the market gives you. I mean, as I get older, I look at businesses. I think many businesses are like that. You can be good, and you've got to have the opportunity. And actually, that all comes back to robustness, because if you're around for long enough, you will get the opportunity. The times are always changing, so if you last long enough, you will live through patches of opportunity. So to do that, you need to be robust.
Do you find it unusual that when you get the question, that if somebody says to you, hey, Mark, I see your performance for 2014. Why is 2015 not as good? It's the funniest thing to me that here so many people out there, they're bright enough to do the homework, and they still are stuck in this other land that even when they want to, they could be interviewing you, they could be interviewing David Harding and Ed Sekoda, and they still ask these questions that seemingly that there's no understanding, even at a very basic level at all, of what you do. If I look at your 2014 performance and I say to you, Mark, why is 2015 not exactly the same? What's your first feeling?
I don't even know.
Please, can this interview stop now?
Yeah. If you ask me that at the beginning, I'll be going, okay, this could be a long interview. Sure, but you obviously, you understand it. You've just got to say, because it's different, because the markets are different, and we can only take what the markets give us. And I think, often you've said in this interview, you said bright guys don't get it. Trading's not that much about being intellectually bright. It's an emotional thing. It's about learning to live with the emotions of going up and down, and learning to do what's counterintuitive. And that's why I think an experienced trader can survive, and a lot of people struggle, because that's the hard thing to do. That is, and in my experience, and even once you do it, it's still not that easy to live with. And I suspect you could ask Ed Sekoda, I haven't asked him, but I suspect you could, and say, how do you feel on the losing days? And you'll say, well, I don't really like it that much. Or they're losing months, or they're losing years, for that matter. Those are the ones and they're hard. And it's not just hard for you, it's hard for your wife, it's hard for your family. They think it's easy, and it is easy when you're winning, but it's never easy when you're losing.
One thing that I always like to kind of pick on trend followers about is what you kind of just went on there, which is the scarlet letter of loss, drawdown, and trend following. It's not easy. But on the flip side, if we were to look at some of the classic low volatility superstar traders of the last 20 years, the ones that make you 1% a month for 5 years straight, and then on the first month of the sixth year, they lose all of it. I mean, literally 100%. I think there's a real, and I would love for you to kind of elaborate this, we have this fascination in society about low volatility. Everybody wants low volatility. Give me that standard deviation that doesn't move much from the mean.
I want low volatility as well.
Okay, yeah, but you can't get it. So that's, I mean, you can't get it, and I'll let you explain it in a second, though. But where I want to go with that is that, so this idea of everybody wanting, or not everybody, but a large number of people wanting low volatility. I mean, the institutional investors, I'm sure they sit down with people like yourself, and that's one of the first things they want to know. But talk about low volatility and risk of ruin. There's a disconnect there that people don't seem to understand, that low volatility does not guarantee you a risk of ruin that's going to be good. I mean, people just miss something there.
Yes, they do, and it's a tricky one to explain. I think, and this sort of analogy I've heard before. I know Dave Drews has used it. Those guys, often those low volatility guys, are picking up pennies in front of steamrollers. Okay, so it works fine until they get their fingers caught, and that's one way of looking at it. Another way I look at it is that we live in a competitive world. Everything involves competition, and that's how the human race gets ahead. No system, no approach will work that well forever, simply because someone else will figure it out, and eventually too many people will be doing it. That's just what happens. So you can have these beautiful approaches that work for a few years, and then either a lot of other people figure it out, so you've got a whole flood of money coming in, the opportunity's gone, or that whole approach was based on a certain set of market conditions, and they change, as they invariably do. So suddenly that approach, which worked so beautifully for a while, maybe it was buying dips in an equity bull run, it's gone. And yet, because your system hasn't thought about that, it hasn't thought about the competition coming in, or it hasn't thought about the market conditions changing, your system is still saying do the same thing, and it can crash. I hope does that give you, is there some insight there? I'm not sure.
Yeah, I mean, you're looking to take on the volatility to avoid risk of ruin, which is counterintuitive. You're kind of paying the market and saying, hey, I will take that volatility because I actually feel better about my risk of ruin. Whereas other people say, no, I don't want any volatility, but they're actually perhaps increasing the risk of ruin.
This might seem like a roundabout way of looking at it, but I've thought about this a lot. The volatility makes it very hard to live with. Okay, and I've said that, and I'm sure other traders are going to say the same, and clients will tell you the same thing. And the very fact that it's hard to live with keeps the competition down, and that gives you an edge. The fact that I can keep executing through bad patches time after time, and the only reason I can is because I have complete faith in what I do, and the only reason I have complete faith in what I do is because I've built it, and I've watched it, and I've lived it. So I can keep executing that through the bad patches, and then I pick up the inevitable win. Sometimes it can be a long time coming, but a lot of other people are going to say, oh, here's another take on it. I could give them my system, right? And we come into one of my poor years, 2011, 2012. Halfway through 2011, they're going to say, that Mark, he's quite a bright guy, and he's done quite well, but that system he's got, it's just not working. I think it's rubbish. I'm going to change it. And that's what happens. They change their system. They change the parameters. They change the idea. They decide that it's going to be better buying low and selling high. And then you're always fighting the last war. And market conditions change, and you don't make the money back.
It's really about having this depth of understanding over many decades. And so while you mentioned Ed Sakota personally going through those decades of experience, you as a trader using software like Mechanica can actually go back in time and apply your ideas and say, hey, what's the if then? What would have happened? Let's check it out. Let's go back in time. And that gives a lot of confidence.
As long as you make the time frame long enough, you've got to be careful with that, because you could go over the last 4 years and you go, oh, this works great. But then if you find if you test it over the last 30, it doesn't actually work so well. So you just need to be a little careful with that. But yes, certainly if you can test over a long time, over a lot of markets, because then you say, well, this thing, it doesn't work that well all the time, but over a long time period, over all the markets, it works pretty well. And I think Dave Drews has used the analogy, it doesn't fit the markets like a glove, it fits it more like a mitten. There's a bit of room for error in there.
3 different types of trend following time lengths in your approach: medium term, long term, and very long term. I thought it was really interesting. You actually tell you state in some of your materials up to 4 years in a particular trade. That almost feels like buy and hold.
Yeah, it does sometimes too. You can sit through some very big drawdowns in 4 years, but that 4 years is the best trade, right? So that's a market that hasn't actually drawn down too far within the 4 year time period, and you get markets like that. I think that's another advantage that I have over a lot of people, or certainly more short-term people. A lot of people don't have the patience to sit with a position for 4 years. And a lot of people also think futures trading is Eddie Murphy or Liar's Poker or something where the guys are in the room yelling and screaming at each other on the phones and they're holding a position for 10 seconds. No, you can do both. And in fact, if you look at the costs of trading, and Ed Sekoda will tell you this, as you go to a longer time period, the fixed costs reduce.
Yeah, I love some of Ed's explanations when people want to trade very short time frames. He's like, hey, why don't we just go for the, some of the speed of light stuff? Why don't we just take it to the fullest extreme? And I think some people still don't get that. Like, hey, I want to be a day trader. I want to trade really short term. And Ed would say, well, hey, come on, just go for the speed of light.
Well, I think a lot of people, and I've thought about this one a lot as well. I'm a price taker, right? I trade the market price that's there in front of me. I have to buy on the bid or sell on the offer. If you're a price taker, you have a certain cost of trading, and that's your slippage plus your commissions. Although your commissions are pretty small nowadays, but the slippage is a big factor. And the more short term you trade, the more times you pay that slippage. It just costs you more and more. If you're a price maker, which that used to be the guys who are the locals on the floor, they're creating the bid and offer, then you probably do want to trade a lot because you're just taking a little bit each time. But as a price taker, which I am, I don't think you want to trade so much.
You're an end-of-day trader, so you're using end-of-day data. Do you use any end-of-week data in your approaches?
No, I don't. But I figure end-of-day gives you end-of-week anyway. No, I don't use end-of-week per se.
The idea of a life. I mean, look, yes, you want to make money. Yes, you're a trader. Yes, you have clients. But, I don't think your idea of a great life would be glued to a screen, becoming a piece of gelatin, sitting in that chair. I mean, we all got to sit in chairs, unfortunately, unless we have standing desks. I miss mine. But talk about the idea of the longer time frame and not, the psychological, the emotional aspects of not being glued to the screen, because so much of the financial world, even the very sophisticated financial world, they're glued to screens during market hours, just watching and attempting to do something in the middle of all of that noise.
I think, well, for a start, you wouldn't want to be doing it in New Zealand because you'd be up all night while the rest of the world was awake. That's the first point. The second point is I think it's a bit like trying to buy low and sell high. People want the short-term fast profit. It just seems to be natural to want that. I don't think trading long-term I think it's a counterintuitive process. I don't think it's that natural. And again, that's probably what helps make it robust.
That might really get at the point, though, is that there's so much natural human inclination to just want the quick buck that if you say to yourself, well, if a huge segment of the population wants the quick buck, perhaps if we go over to the other side of the fence, not expecting the quick buck, that perhaps there's some nice opportunity there.
Yeah, that's not exactly how I got there, but having got there and looked at it, I agree. I got there because of this. Basically, my research pushed me that way because of the slippage costs. Also, looking at time frames, I wanted to diversify. So I do go shorter term, but that's not what anyone would call short term because diversification is a really, really big thing. Certainly in what I do, and I think in what most people do. So you can diversify across markets, and I certainly do that as much as I can. And I also try and diversify across time frames as much as I can, with that limit that I don't go too far towards the short term. And one final point with that, I think the quick profit is instant gratification. I think our society likes that, and probably is heading more so that way with the internet. And you can do everything online, bing bang, straight away.
You mentioned diversification. When I see people compare trend following approaches or trend following track records, that's one of the things they miss, isn't it? There's not perfection. People have different portfolios, and the selection of the markets that one trades has a huge effect on the bottom line. So when one is looking at that track record of any trend following strategy, trend following trader, portfolio selection is massive.
Yeah, it's a massive effect. I agree with you. Again, I think just have to look over a long enough time frame so that the ups and downs of that get evened out. Look over the last couple of years, it's too short. Because if I just traded the 3 best markets every year, my returns would be astronomical. But I never know at the beginning of the year what the 3 best markets are going to be.
So no limitations being in New Zealand. You completely have got this all figured out. How many trend following traders are in New Zealand that you know of? You're not the only one, are you? No.
There were a few guys. The hard thing about being in New Zealand is not the technology. There's not a problem there. It's raising assets. Most people who start here and want to raise a lot of money, they go overseas, often to the UK or somewhere in the Northern Hemisphere, because there's just not a big market here. And even though it's easy to email people and stuff and talk to people on the phone, clients want to meet you face to face.
You know, I had just kind of a fun little side story to New Zealand. I had a chance a couple years ago. I was giving these presentations in Singapore, and this investment bank was kind of shepherding me around for the day. And I ended up in this office, and I didn't know anything about this particular individual. And it was some kind of a penthouse suite office right there on the bay in Singapore. And so I was just a young guy, had invited, I guess this young guy heard I was giving these presentations, and he asked the bank to kind of bring me by. And so we went by and we started chatting, and I walked in, I was like, wow, this place really has some fantastic art. I mean, this is okay. Whoever owns this place, it's one of those feelings you're just like, okay, I've now walked into the room of other money. And this was Richard Chandler's office.
Oh, yes. I certainly don't know him. I've heard of him. Yeah.
I didn't get a chance to meet him. I was just talking to a young guy that worked there that wanted to talk about trend following. But I think what's so great about the world, once one starts to look around and realize how big it is, there is just so much opportunity. There's so many people that have achieved, and it's really fascinating. I mean, I love you're the first person that I've definitely had on my show from New Zealand. So I mean, I just love the idea that we're all connected. There's so many people to learn from. There's opportunity in every country. Every country.
Well, certainly in this business, I mean, I'm just trading with the same markets as everyone else does. I mean, that's where the internet makes things easy. There's no problem with the technology. As I say, the problem is with raising assets. And if you want to raise a lot of money, you've got to pick your family up and take them to London, basically. From here, probably London or Switzerland or maybe New York.
Well, then you have a quality of life issue too. I mean, let's face it. I mean, if one ends up managing, and sometimes there's a tremendous amount of luck involved, but if one ends up managing multiple billions of dollars of assets of clients, I mean, that's a whole different business. I mean, the freedom quotient goes away there. You have no freedom.
Yeah, certainly. And you have to look at it from that perspective. And it's not I'm not going to end up managing billions of dollars of assets, and it's not my ambition. I enjoy what I do, and I'm keen on the performance. And as you manage too much money, it gets very hard to generate the same kind of performance because you get shut out of a lot of markets. And finally, if you live somewhere with a good lifestyle, and you look at the issue of going away to manage a lot of money somewhere else, you're probably going to do that to manage the money, to make the money, then to come back here to live anyway.
Yes, you're already there, so you're like, okay, let's just keep what I've got, the good stuff right now.
Yeah, trust me, I go through that thought many times a week. Should I be here? Should I be in Europe? But I'm here, and this is what I enjoy. And my family's here, and yeah. And as I say, from a trading perspective, it's fine. Yeah. It's only the asset raising perspective is hard.
Well, I've spent a lot of time in Asia in the last couple of years, calling you from Asia right now, so I'm going to have to make it down into New Zealand. I know I think it's about a 12-hour flight from where I'm at, so you are really not close to anybody. But
it's a long way from anywhere. People say, I'll go to Singapore, and then it's another 12 hours to New Zealand. They go, what?
Yeah, it's not. I mean, I was just thinking that too. I was thinking, okay, yeah, maybe Mark's been to Singapore a bunch, but 12 hours, that's like me flying back to the States.
Well, actually, I've traveled more to the US than I have to have through Asia. But yeah, it's a 12-hour hop from here to LA, and you look out the window and you see Auckland disappear, and it's ocean for the next 11 hours and 45 minutes until you see Catalina Island. The Pacific is a big ocean, and we're down the bottom.
Hey, Mark, where's the best place we can send people to check your firm out? MS Capital Management Ltd. Where can we send people to check you out?
the website www.mscapmgmt.com. If it's too hard to spell that, just Google Mark Sleeman Futures and you'll get there pretty fast.
Sleeman.
Correct. Thank you. Yes, Mark Sleeman.
Okay. Cool. Absolutely. Fun stuff. I appreciate it.
Thank you very much for calling. Have a lovely time chatting. If you ever come down to New Zealand, tell me you're coming and I'll come and take you out for lunch or show you where to go. There's some lovely places to see down here.
Yeah, some of the pictures I see, I just have a feeling there's some nature shots and vistas in New Zealand that probably don't exist anywhere else in the world. So I definitely have to see some of that before I leave the planet.
Oh, look, it's people who come here. I'm going to do a bit of a New Zealand tourism plug here, but certainly people who come here, they love it. Look, the country's about the same size as Japan and 4 million people live here. So there's plenty of free space.
Wow.
The scenery's great. Good skiing. Not bad surfing.
Same size as Japan, 4 million people. That's amazing.
Yeah. So it's and if you come down here, you've got to go to Australia as well, which is it's a fascinating country as well. And they're both pretty much next to each other.
Mark, thank you, sir. Hopefully we talk again in the future when if we go by Ed's Gavopoly, and there could be big stuff ahead in the future. And if there's big stuff ahead in the future, I'm sure markets will go in all kinds of large, unexpected moves, and that will make for some interesting banter, I'm sure.
I think there's certainly a chance of that happening.
I see a time when those awake will understand how to make money in up, down, and surprise markets. Whether new trader or experienced, college student or financial advisor, protecting against a crash or just trying to make a lot of money, trend following offers everyone an answer in uncertain times. To get started immediately, send me an email, michael@covel.com. I will send you the right trend following steps to take along with my free video. But if you want to buy and hold, trust the government and trust Wall Street, this is absolutely not for you.